Hey guys, welcome to Pounds Invested. I'm your host, Stephen Georgiev. Before we get into today's video, I really want to thank those of you who have watched my other videos and who have subscribed to my channel already. Now, in today's video, we're going to talk about two very different but very similar sounding ways of participating in financial markets. On the one hand, we have trading. On the other hand, we have investing. How do these two differ? Which one's best for you for profit in the long term? Stick around, find out. But just before we do that, make sure to smash the like button on this video. Right, with that said, let's jump into it, shall we? So, if we just look at the dictionary definitions of trading and investing, we might not really get the distinction. According to the dictionary, investing is the act of spending money now in the hopes of a higher return in the future. Trading is the act of buying and selling investments. Sound pretty similar on the face of it, right? Well, on the face of it they might, but in reality they're very, very different. Put simply, an investor is a kind of person who relies on gradual price appreciation over time, whereas a trader is a kind of person who hopes to make their money by taking advantage of short-term market volatility. Like we said guys, investors tend to favour price appreciation over the very long term. In contrast, traders trade market volatility over the short term. What does this difference look like in practice? Well, an investor might hold an investment for 5 to 10 years. A trader, on the other hand, might hold their market position for as little as 5 to 10 seconds. Yes, seconds. On that basis, we can so far conclude that investing is for the slow and the steady approach, and trading is the fast and furious approach. But there's one other crucial difference between traders and investors. That is, how they use the information which is available to them. Theoretically at least, the price of a financial asset should track the intrinsic value of that asset. But on occasion, human emotions like fear or greed can cause the price to deviate wildly from the intrinsic value of that asset. So, given that we know that there can sometimes be discrepancies between intrinsic value of an asset and the price of that asset, let's look at how investors and how traders use this information differently to try to make a profit. On the one hand, we have passive investors. Now, these guys don't really care about any short-term price fluctuations in the market. Why? Well, because what they're betting on is that over the long term, the market will grow, so that makes any short-term price fluctuations irrelevant. Now, the cousin of passive investors are people known as active investors. These guys try to work out when the price of something is different to its intrinsic value. Either it's underpriced to intrinsic value, so you buy, or it's overpriced to intrinsic value, so you sell. Traders use market information in a similar way to active investors, but they just take it to another level. What does that level look like? Well, traders only care about the price of a financial asset. They do not care about the intrinsic value of that asset. All a trader will care about is whether or not the price of this asset over the next 5 minutes, over the next 50 minutes, over the next trading day is going to increase. They oftentimes do not even know what the company in question does. Literally, they don't necessarily have to know what the company does in order for their trading strategy to make sense. This is because, like we said, traders are simply trying to take advantage of short-term price volatility. Therefore, traders are much more likely to rely on technical signals in a market. So what does that mean? Well, they're going to focus on trying to find technical signals in the way an asset is trading, which then become indicative of patterns in the trading of that asset. Then, once they think they found a pattern in the price history of that asset, they will then try to exploit it for the very short term in order to make a gain. Now, these gains can be tiny. They can literally be fractions of a percentage point made in 2 or 3 seconds. And then they roll up the money that they've just made and move on to their next investment. One other strategy that traders can use is they can buy an asset a day before the company in question announces its latest earnings report, because they've heard that that company is going to have a favourable earnings report, and so they anticipate that the value of that stock is going to go up in the very short term. So they buy it just before that trading announcement is made, and then guess what, guys? Well, they sell it as soon as the announcement has been made to lock in maybe a percentage point or even a quarter of a percentage point of profit. Now, one other interesting thing about the way in which traders work is they will often try to hide the true intentions behind their trades. Why? Well, if you can convince another trader that you don't want to buy a particular asset, you then stand the chance of actually buying that asset at a lower price on the basis that demand for that asset has reduced, and so the price will also reduce. So let's sum up what we've learned so far. On the one hand, you have investors who invest for the long term, hoping to profit off a sustained rise in the value of an asset over time. On the other hand, you have traders who hope to profit off of short-term price volatility, which can literally be seconds. Also guys, don't forget, if you're enjoying this video, be sure to hit the like button. Now, we've covered what trading is, we've covered what investing is, but which one's best for you over the long term? Well, I suppose you could argue trading makes a lot of sense, right? I mean, it sounds great. It's fast-paced, you get quick payoffs, it doesn't even sound like it's that difficult to do. But in practice, if we want to get yacht rich, guys, we can only choose two of the following three options. So if you choose easy and sure, it won't be quick. If you choose easy and quick, it won't be sure. If you choose quick and sure, it sure as hell will not be easy. You can think of trading as being easy and quick, but really incredibly uncertain. Why is it so uncertain? Well, because the market can turn against you just as quickly as it seems like it's going for you. Investing, on the other hand, is easy and it's sure. It's easy because anyone can do it. It's sure because if we look at performance over the past 150 or so years, the stock market has always trended in one direction, upwards. What's the trade-off here? Well, it's not very quick. It can take you a few decades to make your return. So let's recap how traders try to make money in financial markets. Well, they try to take advantage of short-term price volatility in the hopes of making a fraction of a percent in a very short space of time. They then take that return and then roll it into their next trade. Then they take that return and roll it into their next trade. You can maybe see where I'm going with this. At some point, you're statistically guaranteed to lose. At some point, you will make a bad trade. You've rolled each of your previous winnings into every trade as you've gone on. Then when you make a bad trade, you risk losing quite a big proportion of your initial capital. And as an investor, that's something which I really do want to avoid. And I think it's something which you should also look to avoid. Let's remember, if you're trying to be a trader, you're competing against professional traders who have institutional research behind them. They also have cutting-edge algorithms behind them, and they have huge amounts of very, very cheap leverage which they can use to amplify their returns. But be warned, leverage can also work against you. Just as it can amplify your returns, it can also amplify your losses. In fact, trading can sometimes have tragic consequences. So trading is simply not a level playing field. You as an amateur are trying to compete against institutional capital, cutting-edge research, and cutting-edge algorithms which can trade hundreds of times before you can even say the words buy or sell. On that basis, guys, my recommendation, and the recommendation of any advisor in the market, is going to be that for most people, investing is what makes a lot more sense than trading. And to learn more about how to build a profitable investment portfolio for the long term, click the card up here and watch my video on index fund investing and how you can build a portfolio which will generate returns for you over the long term. So with that said, guys, let's summarize the advice for most people. The advice for most people has to be to keep their investments diversified, to drip feed money into the market on a monthly basis, and to hold consistently for the long term. These three things are going to be the cornerstones of any successful investing methodology. After all, these three pillars are what form the basis of the investment methodology of some of the world's greatest investors, including people like Warren Buffett. And what's good enough for Warren Buffett is certainly good enough for me, and I suggest it probably should be for you as well. Let's say you decide that investing isn't for you. Let's say you're happy with high stakes and low odds of success. Rather than day trading, I would probably say you're better off going to a casino. At least that way you're going to get free drinks. And that's all for today, guys. Make sure to hit the like button if you enjoyed this video, and also subscribe to my YouTube channel for more content like this. Now, in my next video, I'm going to be talking about fire. No, not the stuff that appears when you rub two sticks together. Fire. So financial independence and retiring early. I'm going to go into what the movement is, how it works, and whether or not it's a worthwhile investment approach. So to find out that and very much more about the FIRE movement, I'll see you in my next video in a few days' time.